Hello everyone. This presentation was created by Griselva Garcia and Garrett Merlo for the financial analysis of HP and Dow. Our first analysis was conducted by analyzing who are the shareholders of each company. For HP, the top shareholders are Dodge & Cox, Vanguard Group, and FMR LLC. Dodge & Cox is the leader with 7.07%, while Vanguard owns 4.15% and FMR owns 2.79% of the shares. Dell's top shareholders are Southeastern Asset with 7.58%, Price Associates with 3.79%, and Vanguard Group with 3.67%.
From our analysis, we found that the current debt ratio for HP is 30.36% with an optimal debt ratio of 50%. That is a change of 19.64%. The cost of equity is 7.93% with an optimal ratio of 11.58%, a change of 2.44%. HP has a weighted average cost of capital of 6.94%. The optimal ratio is 6.7. That is a decrease of 0.20%. For Dell, the debt ratio is 25.43% and the optimal debt ratio is 70%. This is a change of 44.57%. The cost of equity for Dell is 9.58% with an optimal level of 19.59%, having a change of 10.01%. The weighted average cost of capital for Dell is 7.65% with an optimal ratio of 7.27%. That is a decrease of 0.38%. For this section, we determine what our cost of debt financing is. We see here that we have Dell has an after-tax cost of debt of 1.99%, and HP has an after-tax cost of debt of 1.91%. In this slide here, we show the regression based on a 5-year weekly return from HP and the S&P 500. And here we show the regression for 5-year weekly return for Dell and S&P 500. Using these regressions, we have found that the beta for HP is 0.89 and Dell is 1.25. Using the analyst research, we have found that the average for HP is 1.12 and the average for Dell is 1.42.
Using the data from the company's financial statements, we found that a debt ratio of 30.26% and a market value of equity of 69.74% for HP. For Dell, the data for the company's financial statements shows that there's a market value of equity of 25.42%, and that was the debt ratio was the 25.42%, and the market value of equity was 74.58% for Dell. Using the previous weights and cost of debt and equity, we found a weighted average cost of capital of 6.11% for HP and 7.65% for Dell. This shows that Dell is the preferred company because it has less cost of capital. The calculations in the analysis for HP illustrate that the company should take on 19.64% more debt to lower the cost of capital. The calculations in the analysis for Dell show that the company should take on 44.57% more debt to lower the cost of capital. Therefore, HP would need to borrow less debt according to this analysis, which is an advantage.
For this portion of the project, we've determined that neither of the companies will create unnecessary risk by increasing their debt ratios. That is, if HP raises their debt ratio to the optimal level of 50%, the rating would still remain AAA. As with Dell, if their debt ratio is raised to the optimal level of 70%, they would also remain AAA. For this portion, we've determined that raising the current debt ratio for the company, we see that the financial restructuring of the company would increase the value of the company in both companies. In here we see the current assets and liabilities for HP, Dell, and its two competitors, IBM and ACN. Looking at the stock prices, we've determined that HP is a fairly priced stock. On October 31st, HPQ was valued at 26.61% at the end of the day. According to our analysis, the intrinsic value is 26.3. As of February 3rd, 2012, the stock Dell was valued at 17.66 at the end of the day. According to the analysis, the stock value was 10.83. This shows that the stock was very overvalued.
In conclusion, we choose HP as the preferred company as it has lower weighted average cost of capital, it has a lower beta, and in order for it to reach its optimal levels, it would have to increase cost of debt less than Dell. Thank you.